If you're a real estate investor or high-income earner looking to maximize your tax savings, you've probably heard the terms cost segregation and bonus depreciation. But what do they really mean, and how can they help you legally wipe out six figures from your tax bill? In this video, I'm going to break down exactly what it is, why it's such a powerful tool for lowering your taxes, and how to use it the right way so you can avoid any trouble with the IRS. Stick around because later in this video, I'll explain why accelerating or front-loading depreciation is especially important for a high-income earner to leverage as part of their overall tax strategy. Before diving in, a quick disclaimer. We're not accountants or financial advisors, so be sure to speak with your trusted professional before applying these strategies to your situation. Okay, let's dive in. To understand cost segregation and bonus depreciation, you first need to understand depreciation. For tax purposes, the IRS treats your rental property like it's slowly wearing out over time, even if it's actually going up in value. That wear and tear gets you a powerful benefit. You can write off a portion of that building's value every single year. The IRS lets you count this depreciation as an expense, which offsets rental income on paper. Let me show you what that looks like. Say you buy a fourplex for $500,000. The land is worth $100,000. That part doesn't depreciate, but the remaining $400,000 is the building. The IRS lets you depreciate the building over 27.5 years if it's a residential property. So that's about $14,545 per year in depreciation deductions, even if the property is cash flowing and appreciating. That's the power of depreciation. It creates paper losses that reduce your taxable income without reducing your actual income. This is how many investors can show a loss in their taxes while still making money from their rentals. And this is what you get at baseline with regular depreciation. Next, I'll show you how to accelerate those deductions and how some investors pull 10 to 15 years of depreciation into the first year you own your rental property. So far, we've been talking about regular depreciation. Now let me explain how to front-load the depreciation known as accelerated depreciation. The way to do this is with the cost segregation study. Instead of treating the whole building as one giant asset that depreciates over 27.5 years, cost segregation breaks the building down into parts. How does that help? Well, things like appliances, cabinets, flooring, landscaping, fencing can all be depreciated much faster over 5, 7, or 15 years. And as I mentioned earlier, this is called accelerated depreciation, and in order to take advantage of it, you need a cost segregation study, usually done by an engineer who analyzes the components of your building and reclassifies them based on their useful life. So why does this matter? Because instead of writing off $14,545 per year for the next 27.5 years, you might be able to deduct $50,000 or $75,000 or even more in the very first year. This is how investors create large paper losses early, and this is what helps offset your high income. Without it, a high-income earner wouldn't even be able to make a dent in their income. Now here's an important question for you. What if you could pull even more deductions into the first year you own a property? We'll answer that in a second. At this point, you might be wondering, this sounds great, but doesn't a cost segregation study cost a lot? Is it even worth doing? For most small to mid-sized residential properties like a fourplex, you're typically looking at around $3,000 to do a cost segregation study. Larger commercial properties can cost more, sometimes $10,000 or more, depending on the size and complexity of the building. Now, is it worth it? Let's say you spend $3,000 for a cost segregation study on that fourplex, and as a result, it creates a $100,000 deduction. For a high-income earner in the highest tax bracket, that could represent a $25,000 to $40,000 tax savings, depending on their effective tax rate. So in this example, you get back a lot more in tax savings than you spend on a cost segregation study. But here's the key. To make sure the IRS doesn't challenge your deductions down the road, your study should be done by a qualified professional, ideally a cost segregation company with a team of engineers who specialize in this type of work. And that's what we've done. For our fourplex, we use a national cost segregation provider that sends trained engineers out to properties all across the country. We have personally spent tens of thousands of dollars on cost segregation studies across all of our properties, currently 175 doors that we own personally and over 2,100 doors that we've syndicated. And all that money we got back in tax savings is one of the reasons why we have been able to grow our real estate portfolio so quickly. Bottom line, this is not something you want to DIY or save money by using a software-based virtual study. Work with a reputable cost segregation company. Pay for the engineer to go out to your property. Let the study pay for itself in tax savings. If you want to save time, we've linked our trusted cost segregation partner below. If cost segregation is like stepping on the gas, bonus depreciation is like hitting the turbo button. It's a form of accelerated depreciation, but even more accelerated. Here's how it works. As we mentioned before, when you do a cost segregation study, the engineer identifies certain parts of your building, like appliances, fixtures, or landscaping, and they accelerate the depreciation of these items over 5, 7, or 15 years. Bonus depreciation lets you deduct 100% of those costs all at once in year one. So instead of spreading those deductions over several years, you front load them. For example, if your cost segregation study identifies $100,000 worth of 5, 7, or 15-year components, you could deduct that entire amount in the first year of ownership. Now that's a big paper loss and a huge tax benefit right out of the gate. But this wasn't always the case. Before the 2017 Tax Cuts and Jobs Act, or TCJA, you could only bonus depreciate 50%. The TCJA brought that up to 100% with a built-in phase-out. This phase-out started in 2023, 80% in 2023, 60% in 2024, 40% in 2025, 20% in 2026, and 0% in 2027. But there's potentially good news on the horizon because the House recently passed legislation that would restore 100% bonus depreciation in 2025. And that means we'd stay at 100% through 2029. So it's possible that 100% bonus depreciation will be around for 5 more years. Even if 100% bonus depreciation doesn't come back, accelerated depreciation through cost segregation still works. You just won't get the same immediate boost. Here's what everyone misses when it comes to bonus depreciation. Most people think that without bonus depreciation, it's not worth investing in real estate. The truth? Accelerated depreciation still allows you to front load your depreciation over shorter recovery periods of 5, 7, or 15 years instead of the full 27.5 years for residential properties or 39 years for commercial properties. That's still a huge benefit. In fact, with accelerated depreciation alone, you get the majority of what you would have gotten with 100% bonus depreciation over the first 5 years you own your rental property. In other words, the benefit is about the same. The only difference is that the benefit is spread out over 5 years instead of getting the benefit in the first year. Smart investors know how to adapt to the changing environment, so whether there's 100% bonus depreciation or accelerated depreciation, we'll continue to figure out ways to benefit from the tax savings that real estate has to offer. I'll cover these little-known strategies in a future video. Now here's something most people overlook. You can't always use these paper losses right away, unless you're actively involved in your properties. For long-term rentals, that means qualifying for real estate professional status, or REPS, which has strict time and material participation requirements. For short-term rentals, you don't need REPS, but you still have to materially participate. That usually means spending at least 100 hours on your rental and more than anyone else, including your cleaner, your contractor, property manager, or any other member of your team. So what happens if you don't have reps or if you're not materially participating in your short-term rental? The IRS treats your losses as passive, and passive losses can't offset active income like your W-2 or 1099. Unless you have passive income elsewhere, those tax savings just sit there. They're what the IRS calls suspended passive losses. But here's the exception. If you own your medical office and run your practice, there's a unique way to still benefit, even if you're not actively involved in the property. It's called the medical office tax loophole, and it uses something called degrouping election. This lets you combine your office building and your medical practice into one activity for tax purposes, so losses from depreciation on the building can offset your practice income, even without real estate professional status. We break this down fully in a separate video. Check it out if you're a doctor or if you have a business with your own office space. You might be thinking, aren't I just shifting my tax burden from today to later? The answer is maybe. You do have to eventually pay back the depreciation, something called depreciation recapture. However, there is a way to grow your portfolio throughout your lifetime without ever having to pay it back using something called a 1031 exchange. I'll cover 1031 exchanges and how to avoid depreciation recapture in a future video. Getting back to shifting your tax burden to later, let's assume you don't use 1031 exchanges to avoid depreciation recapture. There's still a big benefit to shifting your tax burden to later, and that benefit is compound growth. When you save tens or hundreds of thousands in taxes upfront and reinvest it immediately, you're putting your money to work sooner. And the longer your money compounds, the more wealth you build. In our own portfolio models, we found that compound growth accounts for a big chunk of our overall gains. So here's a quick recap. Depreciation reduces your taxable income even while your properties are cash flowing. Cost segregation accelerates those deductions, and bonus depreciation supercharges them even more. You need to be active in your real estate to use these losses against regular income, and the earlier you use these strategies, the more powerful the compounding becomes. Now, in the beginning of the video, I mentioned that I would explain why accelerating or front-loading depreciation is especially important for a high-income earner to leverage as part of their overall tax strategy. The reason is regular depreciation isn't going to make a dent in lowering a high-income earner's taxes. I know an oncologist making over $1 million a year. That fourplex we talked about, sheltering $14,545 isn't going to make much of a difference to my oncologist friend. But with accelerated depreciation, sheltering $100,000 starts to make a difference. This is the power of accelerating depreciation. And when you have bonus depreciation, it turbocharges the accelerated depreciation even more. If you want to learn how to actually implement these strategies in your own investing and avoid the most common mistakes, check out our other videos in our Zero to Freedom course that we built specifically for high-income earners. We'll walk you through cost segregation, real estate professional status, the short-term rental tax loophole, and much more, step by step. Now don't forget to like, subscribe, and share this with a friend who's looking to pay less in taxes and work smarter, not harder. And remember, it's not just about making more, it's about keeping more. Thanks for watching, and we'll see you in the next video.